Welcome back to part 2B of chapter 5, where we will continue our costing example with LIFO and weighted average cost. The last in first out or LIFO method of assigning cost to both inventory and cost of goods sold assumes that when inventory items are sold in the reverse order as they were purchased, when sales occur, the cost of the latest units acquired are charged to cost of goods sold. This leaves the cost from the earliest purchases in ending inventory. In a period of rising prices, LIFO also results in lower net income than do the other methods, so it's a great candidate for companies who want to achieve tax savings. However, from a practical standpoint, it is challenging to implement, and once adopted for tax purposes, must also be used for financial statement purposes. And as a side note, LIFO is not currently allowed by international financial reporting standards. Examples of companies who might want to use LIFO are a lumber yard. Think about a pile of lumber. Do you ever take lumber from the bottom of the pile? And what about a pile of coal or of ore or a pile of clay? The first inventory to be purchased is on the ground, and the last inventory to be purchased and the first one to be sold will be on top of the pile. The LIFO example starts with amounts, the same amounts as the FIFO example. We'll see it with weighted average costs too. Beginning inventory included 140 units costing $6 each. On January 10th, 100 units were sold. Since the only inventory available to sell from inventory cost $6 per unit, the $100 bike sold had a cost of $600. This leaves 40 units costing $6 each for a total cost of $240. Do you know the appropriate journal entry to record the sale? Now on January 20th, 60 more units costing $5 apiece are purchased for $300. Inventory now consists of 40 units at $6 each and 60 units at $5 each for a total of $540. Same as the FIFO example. And you know the journal entry. But things get complicated with the next transaction, which is a sale. On January 25th, 80 units are sold. This is the same question as we had with FIFO. Which of the 100 units available shall we sell? Those costing $6, those costing $5. Again, like under FIFO, we have to sell some of both, but which ones? Remember, using LIFO, you sell the units in reverse or the opposite order as you bought them. This means that the first 60 units sold were acquired on January 20th for a cost of $300 or at $5 per unit. The remaining 20 units sold were acquired on January 10th at a cost of $6 apiece or $120. The total cost of sales then on January 25th was $420. And the sale leaves only 20 units in inventory, and they are all from the earliest layer, that is the January 10th purchase, with a total cost of $120. At this point, look at your notes and contrast our LIFO numbers with the FIFO numbers. Now finally, on January 30th, 180 more units are purchased with a cost of $450 each, or $810 in total. This purchase is added on to the inventory previously on hand on January 25th, and now we have 20 units costing $120 and 180 units costing $810 for total quantity in the warehouse of 200 units costing $930. Notice that Laker's LIFO cost of goods sold is reported on its income statement, reflecting 180 units sold at an amount of $1,020, and its ending inventory reported on the balance sheet is $930. Let's take a look at the income statement on the next slide. After Cost of goods sold is deducted from sales. Laker Company has gross profit of $1,680. Subtracting operating expenses of $1,250 and income taxes computed at a rate of 40% of $172 leaves the company with net income of $258. We'll see this is actually higher than FIFO net income because inventory costs are declining, they're going down. So please pause to review the facts given in this exercise at this time if you need to do so. When using weighted average, we assign the average cost per unit of the goods available for sale to cost of goods sold. The average cost per unit is determined by dividing the cost of goods available for sale by the units on hand. A new average cost is computed after every purchase of inventory and is used to assign cost to the next unit sold. Cost of sales and inventory then are valued at amounts that are in between FIFO and LIFO. Our weighted average example starts the same way as does LIFO and FIFO. So I've started our discussion as of January 20th. After the purchase of 60 units on January 20th, inventory consists of $40 at $6 a piece and 60 units at $4 each for a total of $540. Same as the FIFO example. But this is where things change. After every purchase, the accounting system will recalculate average cost. The new weighted average will be used to assign cost to the next sale and to remaining inventory. To compute average cost at January 20th, then, we divide 540 total cost by 100 units to get an average cost of $5.40 per unit. And the next sale on January 25th will be recorded at this average cost. So on January 25th, then, 80 units are sold. At this time, we ask a different question. How should we cost those units? The answer under weighted average is that they are assigned the average cost that was determined for all units immediately after the most recent purchase. In this case, the cost computed was $540 per unit. The 80 units bear the same cost, for a total cost of sales of $432. The sale on January 25th leaves only 20 units in inventory, and they also carry the same weighted average cost of $540 per unit, for a total ending inventory cost of $108. Now, please note that I'm not rounding my calculation to the nearest dollar here. I'm using at least 2 decimal places. Be certain to pay attention to this advice stated in your homework about decimal places. Now finally, on January 30th, 180 more units were purchased at a cost of $450 each, or $810 in total. This purchase is averaged with the inventory previously on hand at January 25th. Now we have 20 units with a new average cost per unit of $459. Notice that Laker's weighted average cost of goods sold reported on its income statement is $1,032, and its ending inventory reported on the balance sheet is $918. Before we review the income statement on the next slide, it might be a good idea to pause this video to review the results of weighted average with LIFO and FIFO in your notes. So after cost of goods sold is deducted from sales, Laker has gross profit of $1,668, subtracting operating expenses of $1,250 and income taxes of $167 leaves the company with net income of $251. We'll see this net income is between LIFO and FIFO net income on the summary on the next slide. This exhibit then reveals what experienced business people know. The costing method selected can have a significant impact on profitability. However, just because you are dissatisfied with the way a method impacts net income Doesn't mean you can change methods every year to get the best results. The consistency concept requires that companies use the same method so that financial statements are comparable from year to year. And the only exception is when a change improves a company's financial reporting. And any change in this policy must be reported in the notes to the financial statements under the disclosure principle. How do costing methods influence net income? In the situation where purchase costs regularly fall, as in LIFO's case, the following occurred. FIFO assigns the highest amount to cost of goods sold, yielding the lowest gross profit and net income. LIFO assigned the lowest amount to cost of goods sold, yielding the highest gross profit and net income. Fortunately for those who adopt LIFO, purchase costs often do the opposite of our example. Weighted average yields results between FIFO and LIFO, and specific identification always yields results that depend on which units are sold. Remember, it can be very costly to use because each item must be tracked individually. In contrast, when costs regularly increase, the reverse to what I just described occurs for FIFO and LIFO. Namely, FIFO gives the highest cost of goods sold, yielding the lowest gross profit and income. FIFO then gives the lowest cost of goods sold, yielding the highest gross profit and income. And this also yields a temporary tax advantage by postponing payment of some income taxes. So during your studies, please be sure you understand under what circumstances FIFO and LIFO yield differing net income amounts. You'll see it on the exam. Each of the 4 inventory costing methods are acceptable. However, a company must disclose the inventory method it uses in its financial statements or footnotes. Each method offers certain advantages as follows. FIFO assigns an amount to inventory on the balance sheet that approximates its current cost. It also mimics the actual flow of goods through most businesses. LIFO assigns an amount to cost of goods sold on the income statement that approximates its current cost. It also better matches cost with revenues in computing gross profit. And weighted average tends to smooth out erratic changes in costs. Specific identification exactly matches the cost of items with the revenues they generate. Companies can and often do use different costing methods for financial reporting and tax reporting. The only exception is when LIFO is used for tax reporting. In this case, the IRS requires that it also be used in financial statements. It's called the LIFO conformity rule. We've spent a substantial amount of time working through the different costing methods. I'm afraid you may be feeling like Theodore. Good job so far. Hang in there. We're through the hard stuff. You will find a number of questions requiring similar calculations on the exam and on the quiz, so please take this as your hint for your studies. Let's take a break, and in a few minutes we'll start part 3 of our chapter.